Greetings everyone, Scott Richardson, Bryan Becker from Richardson Capital Management, here to provide the September 2022 Economic and Investment Update. So at the end of the third quarter, which is hard to believe, and unfortunately the financial markets did not perform very favorably during the quarter again. Actually the quarter started out pretty strong as stocks advanced nicely the first half of the quarter, but starting about the middle of August, concerns regarding inflation and interest rates came to the forefront again, and stocks began selling off, and that continued through the rest of the quarter. Unfortunately, fixed income investments also had a tough quarter as interest rates rose, and so fixed income investments were also negative for the quarter. Now, the depth and the breadth of the declines has been pretty meaningful, and to kind of give us an overview on that, I'll turn things over to Bryan.
Thanks, Scott. So getting back to the financial markets as a whole, what we saw earlier in the quarter was somewhat of a bear market rally. You've probably heard us mention that term a few times, but from mid-June to mid-August, the stock market went up, rallying off in the hopes that the Fed was beating inflation. Around the middle of August, that started to taper out, but the real killer was in the middle of September, where you had back-to-back warnings, one coming from the August CPI report, followed shortly, within days later, of the FedEx earning report, that both show that no, inflation has not been conquered, it is not slowing down, and that's really what sent the markets into a tailspin for the rest of the month. So since mid-September, we've seen large drop-offs in all areas of equity markets, and again, by all areas, I mean large cap, small cap, growth, value, US, non-US, pretty much everything, as well as similar carnage on the bond side of things. As inflation's rising, interest rates are rising, and as we all know, when rates rise, prices fall. So that's really what we've been seeing the last couple of weeks especially, but looking back over the full quarter, the big challenge is, are we going to tackle inflation, and at what cost? Is it going to cause a recession? That's looking more likely. The question now is becoming, is it a shallow recession or a deep one?
Thanks, Bryan. That's a good overview on what's going on the financial market side. There's clearly a lot of uncertainty out in the marketplace, and based on that, in September, we took steps to de-risk the portfolios, given our concerns that the interest rate increasing cycle hasn't come to the end yet. And we are thinking that going forward here, the Fed is going to continue to raise interest rates. They've made that very clear. Their number one goal is to get this inflation under control, and it has not started to roll over in any meaningful fashion yet, although we do think it has peaked at this point. So we're going to maintain a pretty cautious stance for the time being. If we get another one of these, what we call bear market rallies in the next several months, we may take advantage of that to maybe even de-risk a little bit more. But for us to really have a more positive outlook on what's going on in the financial markets, we really want to see the inflation start to roll over in a somewhat meaningful way, and we want to get a lot more confidence that the Fed is closer to the end of the interest rate raising cycle than they are currently. With that, the key takeaways are the fact that it's been a rough start to the year in the financial markets. Inflation is clearly the big concern. What the Fed is doing to fight that and what it's going to do to the economy going forward is the biggest impacts on the financial markets, and we're going to maintain a pretty cautious stance for the time being. With that, I want to thank everyone for joining us. As always, if anyone has any questions or concerns, please don't hesitate to reach out to us. And again, we always appreciate everyone's continued trust and support.
Thank you, and don't forget to like and subscribe.